Hello, I'm Dan Kemp, Chief Investment Officer at Morningstar Investment Management Europe. Welcome to our Q3 update. With the end of the current decade in sight, we're reminded how swiftly the future arrives and how important it is to buy assets at below their fair value with attractive long-term prospects. With this in mind, let's start by assessing the current investment environment. 2019 has seen a continuation of the strong market returns that we've witnessed over the past decade. And many asset classes are now looking expensive relative to history and to our expectations of their fair value. Despite this rise in asset prices, Q3 was characterised by further weakness across the global economy. In reaction, the US Fed cut rates twice, and the ECB not only cut rates, but also embarked on another expanded round of quantitative easing. UK gilts took the top spot in terms of performance, followed by Japanese and US equities, helped in part by currency strength. In contrast, emerging market and Asia ex-Japan equities were weak as global trade tensions continued and Chinese growth slowed. There was a noticeable change in the style leadership over the quarter, with value investors having a better time. There was no obvious reason for this shift as global economic growth deteriorated further, which is often seen as a headwind for value as a style. The performance gap between growth and value remains extreme on most measures, and this may go some way to explaining the rotation we've seen. Against this backdrop, encouragingly, all portfolios produced positive returns over the quarter and are showing strong absolute returns over 2019. Let's now look at how global equity and bond markets have performed. This chart shows the performance of the major equity markets in sterling terms. The bars represent the performance over the third quarter, and the lines show performance over the past 12 months. As you can see, equities in sterling terms had another decent quarter, but it was a tale of two halves. Summer weakness being offset by late quarter optimism, fueled by central bank easing. Japanese equities led the way, with US following close behind. Emerging markets and Asia ex-Japan brought up the rear, impacted by slowing Chinese growth and ongoing trade tensions. Looking ahead, we prefer developed world ex-US equities over the US market, in particular the UK and Japanese equity markets. The UK equity market offers an attractive valuation on a medium to long-term basis and is out of favour with investors due to Brexit uncertainty. We must not forget that UK PLC is very different to the UK economy, with around 70% of earnings from the FTSE 100 companies coming from overseas. We've also been building exposure to healthcare stocks, which offer investors both attractive valuations and quality characteristics, helping to further diversify risk and return drivers within portfolios. We have a lower weighting to US equities, where investors are paying unusually high prices for unusually high earnings. And in our more adventurous portfolios, we maintain dedicated exposure to Russian and German equities. Turning to fixed income markets, global government bonds had another strong quarter, compounding an already strong previous 9 months. Slowing global growth fears of recession in certain European countries, interest rate cuts in the US and Europe, and renewed QE encouraged investors to chase bond yields ever lower. German, French and Japanese yields remain negative, suggesting that bond markets' expectations of future economic conditions are poor. Approximately 30% of global investment-grade bonds are now negatively yielding. As valuation-driven investors, we prefer emerging market over developed market government bonds. That said, the strong returns we've seen from these assets over the past 12 months have resulted in both yields and our expected returns for the asset class falling. Therefore, we've been trimming back allocations accordingly. We continue to monitor markets for assets with attractive long-term valuations and believe our asset allocation research will bear fruit for clients, especially once you factor in risk. We're sensitive to protecting capital given the uncertainties that exist, while still pursuing opportunities that will deliver positive portfolio outcomes. I hope this gives you a good overview of the portfolios and positioning, and thanks for watching.